Hi there, my name's James Heidema, and today we're going to talk about investing. Here's a good question from my son, Paul.
Hey Dad, over the past months, I've encouraged my clients to invest in a certain stock. Recently, that stock is not performing well, but has a history of excellent results. Should I do anything?
Good question, son. I've certainly been in that situation before. I think it's important that first and foremost, you have to look at your job as a financial advisor, your job as a professional salesperson is to treat your customers as a process, not an event. What I mean by that is that when you sell them something, you still have a responsibility to keep in contact with them. And in a former video, I talked about how that contact should happen. But if you treat them as a process, then as things change in the marketplace, as things change in their lives, you should be in front of them, looking to make sure that you make a difference in their lives, that you give them the choices and dignity they deserve, and that they are moving forward with their plan. Now, regarding stocks and bonds and investments generally, is there's a risk with them from generally guaranteed kinds of investments that have a stated return on investment, and then high risk ones that there's no guarantee that it floats with the marketplace. So it's to do with the customer's risk tolerance. So there are ways to find out what their tolerance is, but generally by the sales process, you take them through the gap that you uncover, and to fill that gap, you make a recommendation that they invest. And then that discussion is around how prepared are they for risk. And so if you've got someone calling you that now is upset because the market isn't performing, their investment isn't performing, you have to go back to the conversation you had with them and go back to the process and say, okay, this is what we discussed. This is what you told me at the time. If things have changed from your perspective, then we have a choice either to ride it out, because what really does happen is, over time, the market does perform, but there's peaks and valleys along the way. And this may be a valley. This just may be something that's happening at this point, but may recover. I remember when talk about investment and savings and expenses, the interest rates went from 7% to 22%. And I had a mortgage at that point. So, of course, you move from making your mortgage payment, and some of that payment goes towards the principal and some towards the interest, to where your payments are all going to interest and you're not even touching the principal. And so the market does fluctuate. And so, again, go back to the customer, review why they did what they did. If they want to change, then move them to something else. But make them aware that, because they're dealing with a risk product, that there will be fluctuations. And if they're prepared to ride it out, if all the indications that you see in the marketplace and everything you understand is that this is just a fluctuation, that we can move forward, then maybe they should stay. So, but that's a conversation you have within a process, not within an event. Hope that makes sense to you.